Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back on, Jim.
Ross, we have a question here from one of our listeners. A report was issued here saying that housing prices in Toronto and Vancouver, the price drop right now is just a temporary thing because of the government interventions. They feel in this report that the housing price drop is going to last maybe 2 years, and then if you're waiting to get into the market, now's the time because it may be a lot more expensive in a year or two. Is that true, or is this another case of people not understanding how the real estate market works?
I think what that question relates to is someone who was on CBC. I think it was the national news is where I had heard about it. Now, I know that a couple of the newspapers had similar type comments in them over the last week, and I'll tell your listeners right here before a long explanation happens that it's absolute just nonsense. What these type of people are looking at is that they see when a market rolls over at about a year later, they start to say, oh, well, it doesn't look like the drop is as great as it was in the last year. You're already hearing organized real estate start to talk that way about the Greater Toronto area market. And they're setting people up for when housing prices get released in July and September of this year. They'll be able to make a claim that, oh, things are starting to get back to normal is how they'll word it. Now, all it means is that the way that housing prices are measured everywhere else in Canada, except for with our firm, they're always measuring a year-over-year comparison in a given month. They are not measuring how the sales mix is changing from month to month, how that impacts the average selling price or benchmark prices in that given month, and then what you need to look at to compare to be able to compare one price metric against the other. So I'll let your listeners understand how we measure house prices and why it's different. Since all the talking now is about Toronto, I will use that locality. So right now, if someone was to ask us, what has happened to the Toronto housing market? Have prices dropped were prices really $150,000 less this year versus last? We would say no, that's hogwash. So just like in 2017 in Toronto, where everybody was claiming housing prices were going up $180,000 year over year in March, 30% house price gains, we were telling you that was hogwash. It wasn't true. We were measuring only about a $22,000 increase in price. So the difference between how we measure housing prices and how we measure the housing market versus how the real estate boards do is showing up now in these metrics. And people shouldn't be going out and spending hundreds of thousands of dollars committing to a 25-year mortgage using the housing metrics that real estate boards release to ensure their commission earnings keep happening. The 3.14% drop in prices in the Greater Toronto area, the deflation of the housing bubble by 3.14% over the last few months. That is a huge decrease. Huge. that decrease takes so much out of the market, people have no idea because they're not reading it, the market, the way that we're reading it. A $25,866,000 drop over the last 5 months is staggering for a market the size of Toronto. You're looking at about a 25% decrease in the amount of money being spent in that marketplace to make that happen. So when you're hearing these comments about the market rolling over and that these prices are only going to be lower for a certain period of time, that's simply not true. Housing markets are a function of mortgage interest rates, the amount of home equity carried from one home to another, and how the sales mix is impacting a market on a given month. Unless you're taking all those things into consideration, you can't even make a comment about the market 1 or 2 years from now. Are interest rates going to be 5% 2 years from now? Are they going to be 6? Are they going to be 7? Is the economy going to go into a recession and the government is going to be forced to drop interest rates again? All of these factors come into play. And unless you're understanding how the market works, you can't tell a home buyer what's going to happen with their home value. You can't tell a homeowner whether or not they should be moving up to a more expensive home or they should be waiting till the market conditions are more in their favor. I was talking to someone earlier today, Jim, a big appraiser down from the United States of America. They've invited me to go speak at one of their conventions in the fall. And I was explaining to him how simply knowing which month of the year you should be buying your home, which depends upon the type of home you're going to be purchasing, can make a difference of up to 7% in any calendar year. So in other words, you can get a better deal, save 7% in a calendar year. And I said to him, look, if it's a $300,000 house, 7%, basic $21,000 or $20,000. If you save that $20,000, that means you have 25 years of not paying an extra $20,000 worth of interest and principal on that portion of your mortgage. If you take that $20,000 and you give it to a financial advisor and they invest it for you and they get a 6% return over those 25 years, all of a sudden, that's powerful, powerful retirement money for you. Your listeners need to understand, when you listen to economists and housing analysts and realtors on television, in the media, telling you that this is temporary, they have no idea what they're talking about. The market is only temporary for how it exists today. The underlying factors of the housing market are going to be changing over the next year. If they stay where they are today, housing prices are just going to simply keep dropping. If interest rates go up, the speed with which the price drops will increase. There are no wage increases on the horizon in Canada, folks. People can only pay a certain amount. They can pay no more.
We'll have more with Ross Kay right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
Welcome back. We're speaking with Ross Kay. Ross, a CIBC report released last week said 44% of Greater Toronto condo investors are losing money every month and not covering the carrying costs. What do you make of that report? And does this place the whole market at risk?
Well, I'll tell you, when people listen to reports like this and they get believed, yes, it does put the market at risk because these reports are ridiculous. This report that you're mentioning was issued by CIBC, CIBC Economics, one of Canada's largest banks, by their own economists. And they gave this information out to their customers as a market intelligence to be used in their wealth management portfolios. And the sad thing is, people will believe this report because it came from some economist who shows up in the newspaper every day. And we would say this report is hogwash. Now, your listeners say, well, Ross, this report claims that people the condo investors were losing as much as $1,000 a month on their condominium investment. In other words, they bought a condo, they leased it out to someone, and they were getting $1,000 less than what their mortgage payment, their condominium fees were costing them. What I would say is that this is another case of a bank economist not understanding the proper way of investing in real estate. This is another economist or housing analyst or realtor who does not know how the real way to make wealth by real estate investing needs to take place. And I'll let your listeners understand that by understanding this. They were using a 20% down, 20 to 25% down scenario, cash down, the rest financed. Meaning, the mortgage was about 75% of the value they were using to calculate whether or not the landlord was getting enough money to cover his expenses. What they didn't tell anybody is that the amount of principal being paid down each month with that mortgage payment was offsetting the shortfall in the rent, the difference between the rent and the mortgage. So even though there was a shortfall, the net fact for those people, the 44% cited for losing money, they really weren't losing any money. They were either breaking even or making a small net profit because they were paying down their principal with the extra money they were contributing to make up for the shortfall. All $1,000 of the shortfall was going directly to their mortgage principal. In other words, they simply took $1,000 out of one of their pockets and put it back in the other pocket. It was no loss. Most of these economists, these real estate investing networks, the one Don Campbell, big one Don Campbell, where he charges you hundreds and hundreds of dollars to be a member. It was a joke when Don started it. It's a joke today. He's another failed realtor. People don't understand that. That's where he got his start. He wrote that book back in the late 80s or early 90s, and he sent it out to all the RE/MAX offices. We got a copy. We opened it, looked at it, laughed, and closed it. Yet he's built a very profitable business from that book, from those days. But the truth of the matter is, your investment can't use cap rates. Cap rates are fine when interest rates are extremely high and you're relying on the cash flow to make a profit. But when your interest rates are low, cash flow no longer matters. Our personal investing strategy for real estate, all of the programs that we oversee or strategies we oversee, we believe you shouldn't even be looking at cash flow because you shouldn't be taking any. We believe that there's extra cash flow that should be going to pay down the mortgage quicker so that you can go out and buy more properties. It isn't so that you should be able to fund a trip down to the Bahamas. You should never, ever sell rental real estate. We said that on your show before. Real estate investors never sell. All they do is they reach a point to where their mortgages are paid off, and at that time, they start taking an income from the property. And they continue to take that income from that property till they die. And when they die, that real estate investment is left to the next generation. It is never sold. It is an income-producing retirement vehicle, nothing more. CIBC economists didn't understand that when they did this big report. All of their wealth clients were misled because what CIBC Wealth Management wanted to do was they wanted to sell them stocks and mutual funds. They didn't want them to go out, their clients to go out and buy an investment condo. I'm not saying that's the right decision, but if that happens, CIBC doesn't get any money. CIBC only gets money if the people buy stocks and bonds using their wealth management or their GICs or their ETFs or their mutual funds. They don't get any money if their wealth management clients realize the gains to be made in rental real estate with zero risk. We don't care if there's a house price correction. We don't care about anything because all our plan is 25 years from now, we are not going to need an RSP. We're just going to collect the cash flow from our houses.
We'll have more with Ross Kay right after the break.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead-zinc-silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineered gold mine in the Atlan District of Northwestern BC. Check us out at blindcreekresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're chatting with Ross Kay. Ross, a report was issued saying Vancouver single-detached sales had plummeted to a record 27-year low. Another report said Toronto had reached a 23-year low. Now, you warned our listeners about this back in the fall of 2016. Is what's being reported now true and confirming your analysis?
Okay, so I think what you're citing is you've got a bunch of realtors out there once again blogging, don't sell any real estate. They're trying to make money some other way. That's what you're talking about, Jim. You're talking about realtors saying that I think it was Vancouver is at a 27-year low in the city of Vancouver, the sale of single detached homes. Toronto, the realtor's claiming that it's a 23-year low. What I'll tell your listener that is, it's way, way, way longer than that. It has been it is probable that the sales rate for single detached homes is at its lowest of all time in Toronto and Vancouver. These real estate agents, the reason they quote 27 years, probably the chart will show back to 1990, and probably for the one who claimed 23 years, it'll go back to somewhere around 1994, because that is their reference point. They don't have the data from years before. They think that they're smart using real estate board stats to measure house prices and house sales. You don't hear them talking about the trading rate. You don't hear them talking about the size of the housing stock, single detached, in the Greater Toronto area, maybe double what it was 23 years ago. So obviously, if you hit a 23-year low, it's way, 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 way slower than that. Both of the reports that you're talking about, if they're citing 23 and 27 years for Toronto and Vancouver respectively, are wrong. And if it's issued by a realtor, they should be charged by the provincial regulator for issuing false, misleading, and misrepresentative housing statistics to the public. These are the types of problems that on the way up cause the housing bubble to get bigger, and people to get sucked into paying ridiculous prices, overvaluations for property. And it's the same thing on the way down that can cause a housing bubble to not deflate, but to crash. It can cause it to pop. You have a bunch of people who have no idea about how a housing market functions. They have no idea on even how to count simple sales and how to compare them from one year to another, commenting about the housing market and setting off fear-mongering. Now, that fear-mongering over time may reach a certain velocity where a lot of damage is done. The damage was done on the way up. The damage is going to be done on the way down if you're getting your advice from a realtor or a blogger. That's simply the truth.
Ross, a reader asked if this statement was true. One of the key signs of a housing bubble is when more and more people start to buy real estate strictly as an investment rather than a place to live. Is that true?
Another myth about housing. And again, I was talking to the fellow this morning, and I'm going over, and this is an appraiser. He runs an appraisal network. So this is a guy who knows how housing prices go up and down. And I'm sitting here on the phone for about 2 hours with him, debunking myth after myth after myth. And at the end of the conversation, I'm assuming he was shaking his head at the other side because he's laughing, apologizing for the fact that he doesn't know what I'm talking about. There was even some of the simplest things. He asked me to explain it a couple of times because he could understand what I'm saying, but he has such a history of believing what is out there that it takes a certain number of times before you start to see things differently. People didn't believe that the world wasn't flat. They really believed if you sailed your boat out, you were going to fall off the edge and die. They didn't believe the world was round. It took a long, long, long time for everyone in the world to accept the world was round. It may have taken a generational change, for all I know, for people really to believe that. This is what we're talking about here with your housing metrics and your housing bubble. A housing bubble inflates every single time the bank loans money at the current market value you have negotiated in your agreement of purchase and sale. As the bubble is inflating, every single one of those contracts in aggregate builds the housing bubble. What has a housing bubble deflate is when those contracts start to appear to no longer be inflating the bubble, because the bubble either inflates or it's deflating. It's a natural consequence. Either the bubble inflates or it is shrinking. There is no neutral balance. That's another common myth. There is no balanced market. What you've had in Canada since around 2003 was a gradually expanding housing bubble that over the last 5 years expanded at a very, very increasingly rapid pace until it reached a point it was no longer inflatable. In other words, the bubble really wasn't popped with a pin, but it simply exploded because there was no more air left. There was no more room for the air coming into the market. And that's what people have to understand. A housing bubble is a function of the housing market. It is a function of you negotiating a price with the seller without you having all the details and metrics and understanding of the market that allows you to make an informed negotiation. The buyer is always at a disadvantage. As the buyer negotiates the price, they always overpay. Unless a housing market is correcting, buyers always overpay. The degree that you're overpaying is depending upon what part of the trading cycle you're purchasing in. And that's what your listeners need to understand. A housing bubble is a natural occurrence of a North American housing market, whether it's in the United States or in Canada. Because in our market, you borrow money, mortgage loans, against the price that you offer on the property. I can assure your listeners, when an appraiser does an appraisal on a duly authorized agreement of purchase and sale, almost always is the appraised value going to justify what you offered. It only stops doing that when the banks send out an instructions to the appraiser. We don't want you to appraise the value at today's price. We want you to appraise it on the 3-month-old value. Or we want to appraise it 3 months forward because we know housing prices are decreasing. We don't want you to inflate the price any longer. It's in Canada, even though home buyers pay for the appraisal at the bank, it's the bank who owns the appraisal. It's the bank who tells the appraiser how to create the market value price. The home buyer has no say in the matter. It's the bank. And as the housing bubble inflates, the banks want to book more mortgages. And because if they don't book more mortgages, the CEOs of the bank are not going to get their bonuses. And I'll leave it with this today, Jim. In February of 2018, year over year, there was only 60% the amount of new mortgages booked at Canadian banks as there was February of 2017. Only 60% of the new mortgages booked at Canadian banks this February versus what was booked a year before. That is a huge decrease in mortgage debt being booked. This metric is, if you Google it, you can't even find it. One of the simple, basic measures of a housing market. How much new mortgage debt is booked this month? Not how much mortgage debt for the country goes up, how much new debt is booked. You can't find new mortgage origination debt. All you see is a graph that shows you increasing total mortgage debt. Housing bubbles are built on mortgage debt, nothing more, nothing less.
Ross, thank you so much for the update.
Hey, thanks a lot, Jim.
My guest has been home ownership consultant Ross Kay from the wealthyhomeowner.ca. You're listening to HoweStreet.com radio. Our popular YouTube channel is Talk Digital Network. Find us on Twitter at HoweStreet. Questions for the show or our guests, like Ross, can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HoweStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HoweStreet.com radio is a production of HoweStreet Media Incorporated.